My name is Anthony Fatsis, and welcome to the What the Finance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again, and I hope you enjoy. So, Braden, thank you so much for joining the What the Finance podcast today to speak with me. So just on to my first question. You talk about how you started your career as an engineer and now you're an investor. Can you explain how that happens and how you got into investing?
Yeah, sure thing. Thanks for having me on the podcast, by the way, Anthony. I think you're doing some good stuff. And I got into this stuff when I was still in school like you. So I think that is a good place to start. So I was, I am an engineer by background. And to no one's surprise, I was a math nerd in school. But don't get me wrong, I had some fun. But I was probably the only guy who was building spreadsheets for fun and then going to the bar, like within a 30-minute window. And I was 18 or 19 at the time when I got started. I was kind of obsessed with hyperscaling my knowledge on different business models, personal finance. It's kind of led you down the rabbit hole of investing in public markets because the barriers to entry and the friction to get started investing in public companies is so easy today with the internet. And that's a tremendous improvement from what the incumbent looked like before. But um my strategy and my framework has improved and changed over time, and I think that's totally normal. I worked in automotive manufacturing for a few years. I was in that sector. I did renewable power, I did renewable energy, even some nuclear stuff for another few years working as an engineer, all in the background. I'm managing my own money. I'm writing a blog, trying to, do go on podcasts and just trying to learn from people smarter than me, basically. I was I was doing this podcast called The Canadian Investor, and I do it now. I started a few years ago. And we turned the existing blog, which was Stratosphere Investing, into a web application, which is a platform to do stock research on your own, which is completely free. And then you can opt in for paywall to see my team's research, like myself and analysts. But the platform is completely free for the most part. So that was basically the journey going from, part-time to full-time with finance. And it's been fun. That's basically the journey. It was a passion from the start. And I always knew I wanted to do something entrepreneurial. So yeah, here we are.
Yes, that was a mix of, as you said, your entrepreneurial passion, but also at the same time, the analytical side of things and the quantitative side of things that you are used to in engineering.
That's right. Yeah, it all blended together in something that I thoroughly enjoy and would do anyways, regardless. It would be something that I'd be doing no matter what. So I think I'm pretty lucky from that perspective.
Yeah, awesome. And you talked about sort of your investment philosophy and strategy. Can you maybe go into that a little bit more? And what is your investment philosophy?
Yeah, I try to keep it pretty simple. I'm trying to own the best businesses in the world flat out and try to pay a price that makes sense for the quality of that great business and the growth runway ahead of it. So those kind of all factor in. And I can go over what my framework looks like, but it's pretty simple. I have 6 pillars of kind of requirements of what makes businesses great, and then some additional qualities I can get into. So I mean, for like right out of the gate, I need to find businesses that have proven top line growth, proven sales growth. As an entrepreneur myself, I just can't invest in public codes that don't have top line revenue growth. And we can go into, what I think some of the early mistakes I made early in my career are investing in public markets. But I think investing in companies that are growing their top line at a minimum avoids some mistakes. So I think that's a requirement right out of the way. And then they have superior reinvestment opportunity. So reinvestment opportunity in terms of frequency of opportunities and then the quality of them as well. So you can find that with companies that have sustained high returns on invested capital. So that's a metric you can use. If it's a bank, return on equity is something that you'd be looking at. But for the most part, companies that have superior abilities to reinvest in their business, basically managers have a few branches of opportunities with capital allocation decision. They can return money to shareholders via dividend or stock buyback. They can acquire new businesses, or they can reinvest. And this branch splits out into multiple opportunities, but they can reinvest in the business. And some companies just have better reinvestment opportunities than others, and that's just a fact. And I want to try to own the ones that have great opportunities. I like investing in companies that have a underlying secular trend, and we can talk about that more later, which is something kind of underpinning their growth strategy from a largely macro perspective. So if we're talking about a company that is innovating in digital payments, they're being underpinned by the acceleration, which is the adoption of digital payments and cash being the incumbent. Cash is useless in terms of transactions in a digital world. And COVID-19 accelerated that, but that's not why it started. It started because cash is just not a superior way of transacting compared to instant digital means. So that would be an example of a secular trend. And they have to have pricing power, Anthony. If you come listen to my podcast, you'll know I talk about companies with pricing power every single episode. And it's probably going to continue because companies that can decide their prices are just so much better than companies that are at the will of the market. So whether the business is commoditized, that's basically what you're looking for, is companies that can reliably and durably increase prices over time. And I think that really helps in an inflationary environment, perhaps like what we're seeing today as well. So those are some of the basic ones. I can rifle off some other desired qualities. High margins, network effects, durable, easy to understand, management that doesn't make me scratch my head when they talk on conference calls. And I really like founder-led businesses today too. I think that companies that are publicly listed, worth billions of dollars, but the founder still wakes up every day and works like they, might not get their next meal. Those are really, really successful investments over time.
Yeah, definitely listed off so many different things to watch there.
So many, yeah.
I guess that's the thing. It's like trying to find that balance between when do you stop? Because there's, as you said, there's so much data there. There's so many things you can analyze. Do you have any advice for that, maybe?
In terms of there definitely can be decision paralysis. And I think that that's something that investors face constantly, whether you're a brand new investor or you've been in the public markets for decades, is you will always be running into decision paralysis. But that's a good thing ultimately, is that you have so much optionality as an investor. Like, as someone who is completely unconstrained into the opportunities they can enter in with their personal portfolio, or if it's a manager running basically a very limited constraints on their book, that optionality is wonderful. It's beautiful. So it is a bit of a catch-22 where you all of a sudden maybe have too many decisions. But I think going back to some really simple things, like when I was just talking about pricing power, that eliminates like half the market right out of the gate of just companies that I'm not interested in owning. It eliminates all materials, all commodities, all energy. It eliminates a good amount of public listings. So I think there's ways to narrow your focus in on quality and at least growth at a reasonable price, and you'll be able to narrow it down to at least a workable amount of investable ideas.
Yeah, definitely. You mentioned pricing there again. I know you mentioned it before. So it's obviously very important in your analysis. And I guess you could maybe link it to Warren Buffett, the classic moat. So is that something that you're really looking for, that moat around the company, where if they increase the prices, they're either it's so desirable that they, customers are willing to pay it?
Yeah, I think that that's important, and it's telling of how much customers actually like the product. Investing in companies that the customers don't like the product is very difficult. I think I was talking about my podcast yesterday about airlines.
Yeah.
I don't want to own any airlines. I don't care if they're a good trade right now. customers hate airlines. They're completely commoditized too. There's no brand loyalty to paying up for a flight. It's you press whatever one's the cheapest.
Yeah.
That's an example of a company I'm just not interested in owning. In terms of durability and their moat and their ability to fend off competition, I think that one of the most important ones and the most powerful ones today and moving forward in this uh, digital global economy with with billions of customers potentially on the planet, right? We have this global market that scalable companies can now distribute their product digitally or via physical product to billions of customers in a global economy. And I think that that's a huge shift, and one that is really important right now in durability and mode is network effects. Is companies that have this deeply entrenched network effect, it becomes very difficult to disrupt it. The example I really like to use, and two businesses I think that are just exceptional, are Visa and Mastercard. It is so deeply entrenched from a network perspective that innovating outside of the rails that they've built is very difficult to build. And perhaps this DeFi and crypto landscape is the one that can do it. But I don't think anything else has a standing chance of disrupting the payment rails, because if you come out with some new idea and you say, Anthony, you come up to me and you go, Braden, I have a new card that I want to use, and there's this awesome rewards and awesome cash back, and it's great. It's way cheaper for merchants than Visa. And I go, okay, who takes it? Oh, no one takes it. So you have this network effect being built, and that's just an easy to understand example. But when it comes to moat, that's one that we're always looking at.
Yeah, definitely. I guess you could link that to PayPal as well, how they're sort of trying to take the online almost version of Visa and PayPal, Visa of Mastercard, aren't they? Where
Yeah,
there's probably less moats involved, where there's not actual physical like card machines and all that stuff in the shops.
that's right. It's funny. That's an interesting example too, because even most of the volume is still moving through the payment rails, which are
Yeah.
the card networks. So yeah,
Yeah, it's just like a layer on top, isn't it?
that's right.
Okay, perfect. And what would you say was your influence for your strategy? Where did you get this idea? Is there, was it Warren Buffett or someone else or a few people?
Yeah, you know what? In terms of studying investing grades, I've read most of the classics. For me, I think that I don't have one sort of north star in terms of super investor that I can really point to. I think the one that would stand out the most is probably Chuck Aker of Aker Capital Management. Lots of stuff on their website about what makes durable businesses high quality moats, and what they call the three-legged stool. It's something you can look up after. It's That's one that I would say my investment strategy mostly um compares to. But saying that puts me in a puts me on a pedestal that I don't deserve. I mean, these guys have been doing it for many, many decades, and I've only done it for one. So yeah.
Yeah, awesome. That's interesting. I've never actually heard of him. Is he Canadian based or US based? Or
No, it's US based. Yeah.
okay, yeah, well, I'll definitely have to look into him, and I'm sure I'll learn some good stuff. So many of our listeners are based in the UK and the US, or even Australia. I think we have one
Nice.
from Quebec, I think. So we have one Canadian, which is quite good.
Yeah.
Yeah,
The
represent.
French Canadian.
Exactly. So sort of when looking at the Canadian economy and the stock market, is it similar? Is it different to these economies? How would you define it?
Yeah, investing in Canada is a funny and interesting topic, and a lot of your listeners can definitely, if they're not from the US, relate to some of the things that I'm going to say about investing in Canadian stocks. There are some awesome opportunities, don't get me wrong, and there's some great opportunities in Canada and internationally of businesses that don't trade, just straight up don't trade on US exchanges. So that's great. However, the list of them I can pretty much put on these two hands. There's just not that many great ideas. and that's unfortunate. But let's look at Canada, for instance. If we look at the TSX Composite Index, the Toronto Stock Exchange Composite Index, or the TSX 60, or you include a couple hundred companies, it doesn't matter. You run into basically the same thing. So Standard and Poor's, they publish stats every year on international markets, and they do one on Canada, on the market and the indices. That's their business, right? The S&P 500 is an index that they maintain. 37% of the Canadian equity index is in the top 10 names. So very concentrated. And in that concentration, you have largely banking, energy, and telecommunications. So you have large regulated businesses that dominate inside the border and have some but limited growth opportunities outside of the border. That is a generalization, but a fair generalization of the top 10 names. If you look at the World Equity Index, the top 10 names only make up 7%. So you can see that 37% versus 7%. So there's some concentration risk there too. And the Canadian index is basically overweight financials, energy, and materials. Now, I just said that energy and materials are something I'm not interested in at all. I do think that the Canadian banks are ginormous profit centers, and will continue to be able to print cash and actually have some interesting growth opportunities outside of Canada. But the excluding the Canadian banks and Shopify, the top 10 names in the index are not that interesting. That being said, there are some interesting gems, and this goes with not just Canadian codes, but your international listeners as well. Is there are Canadian companies and international companies that are not listed in the US that basically are undercovered. They're just flat out undercovered. There's no analyst coverage. Managers and funds and even retail flows are largely being arbitrarily constrained to only US listings, which is fair enough, to be honest. I mean, if you are a US investor and investing in international opportunities, you're basically introducing currency risk, operational headaches. You're introducing these kind of dynamics for limited opportunities to begin with. So I can understand why you wouldn't want to go there. That being said, in Canada, there are some real gems. There's this great Canadian roll-ups like Constellation Software. It's been one of the most best performing publicly traded companies in the history of the world. TFI International, First Service, GFL Environmental, Brookfield. These are companies that are roll-ups and largely global enterprises. Now, notice how I didn't mention any names that are just doing Canadian business, right? The Canadian population, I think, is like 38 million today. I just talked about how I'm interested in billions of customers, right? Not 38 million. So there are some real gems that trade just on the TSX, for instance, but the gems all have global opportunity and aren't constrained to inside the borders of Canada. And I think that that's an important distinction to make.
Yeah, it's interesting. And I think Constellation is, did I see correctly that it's over 30% of your portfolio?
Awesome. Yeah. And their spinoff is another 9%. Yeah, close to 50% is concentrated in basically Mark Leonard's Constellation. So, yeah.
Wow, you must definitely believe in it then.
It's hundreds of companies, right?
Yeah.
It's a roll-up strategy of hundreds of different vertical market software businesses that operate around the world with very sticky customers, mission critical niche type software for their operations. And I feel very comfortable owning that, but you can't borrow conviction, right? And that's an important piece to specify.
Yeah, definitely. And I think, as you said there, a lot of the developed countries like Australia and Canada, they're quite similar. They're very much materials based. I'm sure Canada is very much oils based and other materials, and then financials. So, but you're saying looking for those little gems that are potentially could build that worldwide scope.
Yeah, they have global opportunities and are undercovered. So you might have great businesses with great run rates trading at reasonable prices, and that's that's something I look my chops on. Those are hard to find.
Yeah, definitely. And you mentioned at the start there that you're the founder of Stratosphere Investing, which is sort of, I think I saw somewhere it's quoted as being equivalent to a Bloomberg Terminal for the price of Netflix. I think I got that correct.
Hey, I like that. I like that tagline. Yep.
Yeah, definitely. So, what would you say? Obviously, it's very data focused. So, what would you say the most important pieces of data you look at when analyzing a stock?
Yeah. So the platform is completely free to look at financial statements, growth rates, valuation multiples, just right there on every North American listed stock right now. And we're hoping to roll out global coverage. But really, at the end of the day, like for me personally, it sounds so cliche, but it's true. I built Stratosphere because I couldn't find 10-year financial statements anywhere. If you go on a company's IR on their press release, you'll find, you know, year over year comparable quarters like the comps growth, and you'll find maybe 3 years or 4 years of financial statements on some of the free sites out there. I was like, why? Like, some of these great durable businesses like Coca-Cola, I want to see a 10-year statement. I want to see, what the landscape looked like 10 years ago, because that might be relevant to me. That's really why I set out to build it, was I wanted 10-year financial statements. And then we added on all these other features onto it, of course. But I like screening for some of those qualitative factors, some of the growth factors that we were talking about. And then that's just the start, right? You got to dive into the qualities of the business. What makes the business great? What makes it durable? Who are their competitors? Who's the management team? Is it someone that you can trust? So starting from an analytic perspective makes sense for me. I know a lot of people start the other way around. They go, wow, I just went on vacation and I stayed in Airbnbs for 30 straight days. Should I look at Airbnb stock? And then they'll look at the financial statements. And I think that that's a good way to go too. You can understand the business really well before even looking at their statements, from my perspective. But it really comes down, like, I'm an analytical person, so I look at financials and use a stock screener, stuff like that, to look at what might be an investable idea. But once you narrow down, the growth runway is solid, the price is reasonable, the business is exceptional, then you might have a good opportunity there. But I think you got to be patient, and you can't be jumping on new ideas left, right, and center, or else you'll end up with a 50 stock portfolio, and that's not what I'm trying to do.
No, definitely. And then in terms of constructing your portfolio, how would you go about that? Obviously, you said you're quite exposed to, it's hundreds of companies, but how do you construct your portfolio and your diversification and all that?
I use something called I use very loosely the Kelly criterion for position weighting. So the Kelly criterion is basically a mathematical formula. I don't use it as a mathematical formula. I take it and take the concept of it. The concept of it is basically, you want to size your bets. So the Kelly criterion was initially built for betting application, right? Like, I have a strong conviction that the Cowboys are going to win this football game, so I'm going to bet more money on that. Even though the payout might be lower because they're a huge favorite or something, I have high conviction that it's going to happen, so I'm going to size that bet bigger. That's a very similar application with your investment portfolio, where you have your highest conviction names, your most likely to be right names make up a big portion of your portfolio. And if there's some companies that are, have huge optionality, massive growth runways, but still have some things to prove, or they might have, a changing landscape, and your conviction of it is not as strong as some of those other names, you're not going to size it accordingly to something like Constellation, or have, very high conviction that they can continue to acquire vertical market software companies across the planet. So it's kind of like, Anthony, like, if I gave you the bet and I said, you can double your money, you can make an 100% return if you take this bet that the sun comes up tomorrow, you'd be like, yeah, of course. You'd liquidate you would liquidate your entire portfolio and double your money. because you know that the sun's going to rise tomorrow. And if it doesn't, you have more problems to worry about than just your investment portfolio. So I think that kind of speaks to sizing your bets based on conviction, and that's what I do. I rank them literally out of 10 on conviction. It's not scientific, it's not mathematical. It's a lot of feel, but that's what I think position sizing should be.
Yeah, it's interesting. It's quite unique. So as you said, it's looking at like I guess the quantitative way, like the betting analogy, as you said, and then going from there.
Mm-hmm. Yeah, that's basically the gist of it.
Perfect. So you mentioned at the start of the interview sort of the mistakes you made and what you'd improve. So I guess my question is, if you could start your investing career again, what would you change?
Yeah, if I could change what some of the mistakes I made, or I gotta say, I'm quite lucky that I didn't make a lot of mistakes, because for the first part of my career, I was largely in index funds. And so that saves a 18, 19-year-old guy from doing stupid things like losing money. So I think that I was lucky to learn the markets while I was mostly in a passive strategy, while I picked some names along the way and understood what I was doing along the way. But when it comes to stock picking, this is not a new mistake. This is one that I think most investors are realizing that probably wasn't a good idea. Now, what I'm referring to is traditional, air quotes, value investing. Now, all good investing is value investing. So let's clear that up. Buying an asset for something that is less than what it's going to be worth in the future is technically value investing, right? But if you go too far down the business quality scale, you often end up in an arena of mediocre businesses at best. Sure, they might be trading at less than they should, but at the end of the day, I'm trying to play a game where I can buy and hold great companies forever. So value investing in the traditional sense is trying to buy something 80 cents on the dollar and selling it for $1.20. So you're trying to play basically market expansion and compression on multiples largely. Or you think something is massively mispriced or misunderstood by the broader market, and this happens all the time. It's a legit strategy. It's a very legit strategy. However, it's not the game I'm trying to play, and that's what's really important, right? Is to figure out what game you are playing, because this requires a lot of active management that I think that is actually less profitable than owning great businesses for the long term. So an example of this is I'm willing to pay an above, barely these days, but an above market multiple for a business like Alphabet, Google's parent company, which is entrenched in our daily lives. Like, I think I touch a Google product every hour on the hour of every single day. It is so deeply entrenched in our lives with very deep network effects, incredible profitability. The amount of cash they're spitting out is ridiculous. And so then you compare that to a melting ice cube of a business that trades below market multiples. Sure, it may have some attractive free cash flow yields today, but I want to own, very simply put, businesses that are going to be bigger, better, more profitable, have more market share, and have larger total addressable markets today than they do, in the future than they do today. And with many businesses, you just can't check that box. And so I think going back to really, really simple, even like first level thinking with some of this stuff is pretty important. And a lot of investors think they have to make it really complicated when they start their career, because they think that simple can't be profitable, right? These people who do this full time, how can simple be profitable? And then they realize, owning something like Google over the last 10 years, which you were touching every hour on the hour 10 years ago too. How could that be, a great investment? How could there be alpha in that? And it has run laps around the S&P. It's, what's the outperformance on Google compared to the S&P? It's outrageous, right? So I think that's a fairly reasonable example that everyone can understand. And messing around with low business quality is something that I did originally because I thought it they trade at too cheap of prices. Well, sometimes the market's just right and it's cheap for a reason. So that's definitely one for me.
Yeah, I definitely agree with that. And I have been caught in that as well. As you said, they might have had a bad earnings, be like, oh, they're a good company in the long run. But sometimes other investors have to believe that as well. And if they don't, then yeah, you don't have any luck.
But what you're saying is like, yeah, it's down on earnings, but it's still a great company.
Yeah.
No, I think that's opportunity.
Yeah.
If it's down and it's a crap company, it's supposed to be there. It's not a great company. And you don't have to be a business analyst, CFA, CPA, dive into financial statements to say if one company is a great company or not. I think that everyone knows Google's a great company, right? So I think that, again, it is all coming back down to simplicity for me personally.
Yeah, I definitely agree with that. So you mentioned before like sectors that you're watching. So I guess the main ones would be obviously the transition to online and digital. And is that really the main companies that you're watching yourself and that you think will be the best performers, in the coming years?
I think so. I am trying to own companies that are, their growth is being underpinned by some of these secular trends that, they're working with the wind, not against it. And so some of those examples are, obvious ones are cloud computing, data consumption. These things are on the rise, right? That's no secret. But not only from an infrastructure play, like Amazon Web Services owned by Amazon, or Google Cloud (GCP) by Google, or Azure by Microsoft. Those are incredibly good businesses, and the operating leverage that they're going to produce over the next 20 years, I think, will astound even the bulls will be astounded by what they're going to accomplish. But also the physical connectivity of businesses like Equinix and American Tower. Equinix is the largest data center owner of physical data centers, that these companies, like the infrastructure companies, have to own computing power inside of these data centers. And Equinix is a fantastic business. Or American Tower, which is the largest cell tower connectivity type business. There's so much data moving to the edge and Internet of Things. This is a trend that no one's going to stop. So I think that those businesses are important. I like roll-ups and VMS, obviously. I mean, I have 50% of my portfolio basically in roll-ups and vertical market software. But if you think of, largely what's happening right now is in the entrepreneurial space globally, is there's some awesome tech companies being built, and there's some awesome founders that are looking for partial or full exits. And they're looking to do the next thing, because that's what entrepreneurs obviously do. Now, they still built a fantastic business with really sticky business to business type SaaS companies, but they want to do another one, right? And that happens all the time. And so there's companies like CSU that are buying them up, and they're rolling them up, and there's thousands of them. Like you'd think that there's only going to be so many of these software companies you can roll up. I think they're just getting started. Digital payments is an easy one for me. Whether it's the Visa, Mastercard payment rails, or it's the Square, PayPal type plays. I'm actually really interested in Stripe if they actually go through with their IPO. Led up by the Collison brothers. What an incredible company. I mean, I pay fees on my business that every time. I'm happy to pay Stripe fees, because that means I made a sale, right? So I think that's going to be a wonderful company. Video games is another one, but not only from the perspective of the game developers. I actually like owning the game developers less than I would prefer to own Unity or Tencent. The actual platforms that the game engines are on. And when I say Tencent, I mean the Unreal Engine, because they own Epic Games, which operates the Unreal Engine. 3D modeling and immersive environments like Autodesk, Dassault Systems, Ansys, Facebook or Meta now, right? With their new efforts in the metaverse. I think that's legit. 3D modeling and immersive environments are going to be important. And then lastly, I would say, just off the top of my head, is e-commerce. And I mean, all these ones I'm mentioning are super obvious. Like, people know these are happening. But just like I mentioned with some of the companies that have been obviously great had obviously great returns after. Um, and when it comes to e-commerce, whether it's Shopify powering the creator economy or Mercado Libre really making a big impact in Latin America and South America, or SC Limited, C Limited in Southeast Asia, what Tencent's building in China and Alibaba. I think that these companies are going to benefit for a long time to come still. And what we're seeing now is not the end state of what e-commerce looks like. I think logistics is going to massively change. So I think there's some cheaper ways to own it as well, like even like trucking, right? I think there's some cheaper ways to own this growth in e-commerce. So those are some examples of ones I'm looking at right now.
Yeah, it's really interesting. It's all sort of going in the same direction, isn't it? It's all, more online, more into this potential metaverse. And, basically that's where that's where that network effect really grows, I think, when it goes online.
Yeah, think about it right now. We're on a call. It's 2:41 in Toronto. What is it? 7:41 in the
UK, yeah.
UK. This would never be possible. Just, what seems like yesterday. And I think that we will continue to underappreciate or underestimate the velocity of technology and the adoption of some of these technologies. So I think that not fighting against it with your investment portfolio is a bad idea. And so I'm hoping to not do that and be on the right side of that with my portfolio from a secular trend perspective. That doesn't mean owning 50 times sales software companies 100% of my portfolio. That's not what I'm saying at all. It's more so, positioning yourself against giving yourself unnecessary headwinds is something I'm not looking to do. And so I think that paying attention to these trends, even if they're super obvious and super simple, is probably a good way to go.
And obviously for us as well, we're young. So, if it goes down in the short term, it's at the end of the day, we're here for the 10, 20, 30 years.
That's right. You have to know what game you're playing, which investment horizon you're playing. And that's another thing that I think people will underestimate as well, is how long their time horizon. My parents are in their mid 60s. And they basically ask me what to do with their investment portfolio. And sure, I'm more conservative with it than with myself, but I'm looking at their investment horizon as not, the traditional 60-40 match your age in bonds and stocks. I think that that's, not only is it a bad way to go right now with yields on fixed income, but it's kind of always been a bad way to go if your investment horizon is longer than 10 years. And their investment horizon is longer than 10 years. It's going to, investment horizons are going to continue to get longer with the adoption of technologies in healthcare. So, I'm very, very positive about the future. And no matter what you'll see in financial markets, is you have to remember that negative sentiment sells the paper. Negative sentiment sells the paper. Volatility is good for news agencies that sell financial data. So, act accordingly, right? I mean, most of these companies, from a 10-year perspective, even just one quarter or a few days of performance is just really not relevant. And so have that long view, and your performance will just get so much better.
Yeah, I think it's that classic, like you see it, like, oh, billionaires made $40 billion today. And then it's like, oh, the next day, oh, they lost $40 billion. It's just that sensationalism, isn't it?
It's sensationalism for sure. And that's what sells clicks and this click driven attention economy. So people need to be aware of that, and just, take a deep breath. You don't need to look at your portfolio every day. You don't need to look at CNBC every day. It's just really not relevant from a daily perspective. If you're a business owner, that the fundamentals of your company don't change every day. Imagine if you had someone, venture capitalists, come into your office every single morning and value your company day to day. Like, you had, like, yesterday And then this morning they came in and they're like, yeah, we're gonna value your company again this morning. That's what public markets are like. Even though I report you know, my results every quarter, maybe the odd acquisition makes the press release, but business fundamentals do not change that quickly. And that's really important, especially for newer investors, is to understand that focus on real business results, not the stock price. And that's very difficult to do, extremely difficult to do when you can look at your portfolio every second. Um, just a little bit of patience will go a long way.
Yeah, I think that's a great piece of advice. So, Braden, thanks so much for joining the What the Finance podcast. So my last question: what is one message you'd like listeners to take away from the interview?
I think what we've been talking about is having a long view, looking at some of the secular trends, portfolio construction. I think the number one skill for investors is, yeah, we talked about some analytical perspectives. That stuff helps, and you can learn that stuff. You can really learn that stuff. You can hyperscale your knowledge. You can read books, but what you can't teach is some patience and some long view and some understanding that if you buy a stock and you lose your, like, a bunch of this high flying software has gotten, investors have got their faces ripped off in the past 2 weeks, like massive drawdowns on Peloton and Zoom. You didn't buy the stock to sell it in 2 quarters. You bought the stock to hold it for 10 years. So hold it for 10 years, right? Like, the thesis has really, maybe it's changed a little bit, but has the business changed? Is it worth half as much as it was last week? No, it's not. So have the long view on that stuff, and a little bit of patience. You can't teach that, but you can try. You can really try. And that's my number one recommendation.
Perfect. I think that's great. So, Braden, thank you so much for joining the podcast. If anyone wanted to, you said you have the podcast, so do you want to talk about that maybe, and then your company as well, and where they could get in contact with you more?
Sure. Thanks, Anthony. So we do have a podcast that's twice a week called The Canadian Investor. It's great for Canadian investors because we talk about, Canadian markets and some uncovered stuff. But again, I think it's good for anyone because the companies we talk about are like 90% not Canadian. Like, it is like a 95% US based companies we're talking about, just because of the nature of what we were talking about before with, limited opportunities. But I think I think we do some good research and try pretty hard. So there's that. And then Stratosphere Investing is completely free. Stratospherinvesting.com. It's a web analytics platform, like you said. Bloomberg for the price of Netflix. Hopefully one day better than Bloomberg for the price of Netflix, except for the fact that it's free. So the price of Netflix is to uncover our paid research, which is the price of Netflix. So I like that. Which is, we basically go in deep dives onto these companies, into the actual business quality and fundamentals beyond just the numbers that everyone can find, because that stuff's fairly commoditized these days. So yeah, thanks, man.
No problem. Thank you so much. And I'll put that all in the description below. So if anyone wants to see that, they'll be able to
Awesome.
see it. So thanks again for joining the podcast.
Thanks, Anthony. And nice chatting with you, man.
Appreciate it. Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.